While the Fed has not yet begun to lower interest rates, there has been a lowering of rates in some types of debt, especially on the corporate side, and that's leading to a surging corporate bond market. Nina Trentman, senior editor with Bloomberg, joins us with more on that. Nina, great to talk to you again. How are you?
Yeah, good. Thanks. Thanks for having me. Great to be on
So
again.
let's start there. What kind of a landscape have we been seeing in the first 5 weeks of the year around the corporate bond market?
Yeah, we've seen, as you alluded to, we've seen a strong surge in sales this year, both in the investment grade markets as well as in the high yield markets, driven largely by changes in treasury yields. So if you recall, we had high yields in the fall, and they came down significantly before Christmas and before the end of the year. This year, we've seen still treasury yields significantly lower than they were at their highs last year, which is encouraging many borrowers to come to the market, even though interest rates themselves have not moved yet. And we're not necessarily sure when they will, given that the Fed has recently tried to temper some of the excitement that we're seeing in the market for traders pricing in rate cuts for as early as March. Jerome Powell last week tried to reduce that excitement, but companies are going ahead, and we're also seeing that today with about 7 companies in the investment grade bond market, including Eli Lilly, which had earnings out yesterday. Dow Chemical is raising debt today. They had an investor outreach recently, so it's very busy in the market.
And their expectation with the companies like that is that their strength in their earnings that they've seen is going to allow them to go out and add new pieces to their operation in the months ahead, correct?
Yeah, it's a bit of a combination of what's driving companies. So usually we see companies coming to the market after they've reported earnings, assuming that the earnings were reasonably good or were better than expected. So earnings coming out of earnings blackouts is usually one thing that drives companies to come to market. And then also, of course, you would see companies that come opportunistically, basically those that know that they will have a financing need potentially later this year or even next year. And if they think that the prices that are offered in the market are attractive, then they would come as well. Plus, mergers and acquisition financing, of course, is also an important component. We've seen the M&A market involving U.S. companies come back strong this year after a pretty slow 2023. And so the expectation is also that there's going to be a fair amount of M&A related debt coming to the market this year. According to Bloomberg data, there's, I think, over $300 billion that still needs to be raised in that space. So that is also then a driver for companies to come to market. January was interesting. We saw an all-time high of $189 billion sold in new investment-grade bonds, which exceeded a prior record from 2017. This month, people are also expecting pretty high volumes. Bank of America last week put out a report saying that they're estimating between $160 billion to $170 billion in investment-grade debt, which is more than we saw last year this time. So, yeah, I guess if you're a syndicate banker these days or an underwriter, then you're having pretty busy days.
Well, and you mentioned about the mindset of the Fed, and obviously as you said, the comments by Chair Powell earlier this week tried to temper the momentum that we had seen in and around the markets of potentially 4, 5, 6 rate cuts this year. Doesn't seem like we're going to see that. Neil Kashkari, the Minneapolis Fed president, talking earlier today on TV, kind of in that 2 to 3 camp right now. So knowing that seemingly is the mindset of the leadership of the Fed, how does 2 to 3 rate cuts potentially impact the corporate debt market, knowing that maybe there's not as much of a level of relief coming to where rates are right now?
Of course, it depends on the rate that we will see at the end. And I think the expectation is that rates, even if the Fed were to start cutting, would be higher than what they've been for many years. Then also, of course, from a historic perspective, the current rates that we're seeing north of 5% are not necessarily very high. I think the interesting bit will be to see how other events are also shaping the market this year. Because yes, from a corporate perspective, of course, you want to come to market when interest rates, which are an important component for the price for your debt, are coming down. But then also you have the second component, which is the spreads over treasuries that corporates pay in addition to what the U.S. government borrows at. And so that, of course, could go up or could go down again, depend on various events that we're seeing this year. We're also facing a presidential election and the campaign for that later this year. So I think what we're seeing right now with so many corporates coming to market is that they're seeing good conditions in the market, specifically in investment grade, but also in high yield, where we've seen quite strong issuance in January as well. So I think corporates are just seizing the opportunity that they see right now because they don't necessarily know what's going to happen later this year, even though the signals from the Fed are positive as well.
Is there also an element of this that maybe is a tad bit surprising because of some of the global events that are going on? And, we've seen earnings from companies where they talk about the impact of some of the things going on in other parts of the world. And as you alluded to, the presidential race that we're going to have here this year, that those outside components, can play a factor later on this year as well.
Well, specifically when it comes to sort of the price that companies would pay for raising debt, because these outside events tend to or can influence not just stocks, but also treasuries. And if you're a corporate that wants to raise at a certain cost, then of course that adds a little bit of uncertainty to your planning. There are companies that use pre-issuance hedges where basically they take away that uncertainty around what treasury yields will be. But that also can be a bit of a hit or a miss. So some companies use those and some don't. We have, just because I was talking about treasuries, we have a big auction later on this afternoon where there will be about $42 billion sold in U.S. government bonds of 10-year treasuries. So we will also see, of course, how that auction goes and how treasury yields respond to that. But yeah, there's various factors at play that companies are weighing as they're thinking about when and if and when to come to market this year.
But it sounds like the underlying fundamentals are still fairly solid, correct?
Yeah, I think we've seen pretty strong data recently. Overall, I think we've seen a fair amount of strong earnings come out. Of course, we've also seen companies that have announced not so good earnings and also job cuts, but the jobs market data that we've seen has been stronger than what the market has expected, which is why sort of the market was so optimistic about so many rate cuts this year and why there's a divergence between what the Fed is penciling in and what the market is penciling in. So the economic data is still pretty strong.
All right. Nina, great to talk with you. Thanks very much for your time today. All the best.
Thank you.
You got it.